One of the most fundamental laws of capitalism is competition. Whenever you have a successful business, somebody else will try and copy that, somebody else will try and also make money from that business. And here's Warren Buffett explaining a little bit more about that.
In capitalism, when you have a wonderful business, it's like having an economic castle. And the nature of capitalism is that people want to come in and take your castle. It's perfectly understandable. I mean, if I'm selling television sets or something, there's going to be 10 other people that are going to try and sell a better television set. If I have a restaurant here in Omaha, people are going to try and copy my menu and give more parking and take my chef and so on. So capitalism's all about somebody coming and trying to take the castle. Now, what you need is a castle that has some durable competitive advantage, some castle that has a moat around it. And that moat, one of the best moats in many respects, is to be a low-cost producer.
Now, specifically, if you talk about gold finance business in India, at least on the surface layer, it seems to be a very simple business to understand, right? You have gold, you pledge your gold, you get a loan. And on the surface, at least, it seems also to be a business that's easily copyable. But if it is a business that's simple to understand and simple and easy to copy, why is it that companies such as Muthoot Finance and Manappuram, why are these the most profitable NBFCs in the country, right? That's a question. Does that mean they have some sort of economic advantage, some sort of durable competitive advantage that Warren Buffett just talked about? That's another question. Another question is that if they do have a competitive advantage, why is it that in the last 1 year their stock has been battered by more than 30%? That's another question. And among all of that, another great question is that as an investor, as a stock market investor, how would you value such companies, right? How do you find out the valuation of these companies? Now, these are just some of the many questions that we'll seek to answer in this video, specifically around Muthoot Finance. And if you're new here, my name is Rahul. I'm an independent research analyst. I went from being 45 lakh rupees in debt to retiring by the age of 29. And the whole idea around this channel is I make videos so that I share whatever I've learned along the journey, whatever I'm learning. And if you find anything useful in this video, anything valuable, please feel free to click on the subscribe button. It'll help a lot. Now, coming back to the video. So we're going to break down this video into 3 different parts. We'll discuss the business. We'll discuss the growth, where growth can come from. And thirdly, we'll talk about valuations. To begin with the macro view, right, the high level picture, one thing is very obvious, which is that we love gold. As Indians, we are obsessed with gold, and there's a lot of sentimental value for gold, obviously, but it's also a store of wealth, right? And we're so obsessed with gold that, we have around 25 to 27,000 tons of gold with Indian households. And this obsession, by the way, is not only with, let's say one section of the society, the rich or the poor. Across all spectrums of our society, gold is something that we're really obsessed with, right? And estimated, I think we have around $1.5 trillion worth of gold with Indian households. And last year, we are also the largest importer of gold. We import around 25% of the entire world's gold. We're so obsessed that it's almost become a problem. It's almost like an addiction, and the government really wants us to stop with this addiction, right? To switch and give you the government's perspective, the reason why government is not so happy with so much amount of gold with Indian households is because you see, when you buy gold, what you do is you put money, you buy that piece of metal, and then it does nothing. It just lies there, right? From the government's perspective, what they want is, and they've tried to introduce different measures to reduce the amount of physical gold we hold as citizens and switch to other forms. So for example, there are sovereign gold bonds that you can buy digital gold, and the whole idea is that if we can just move even a small percentage of this $1.5 trillion worth of money that's locked, that's kind of unproductive in the gold metal, we can use that money and build infrastructure and direct it to other parts of the economy that require that kind of money, right? So that's the government's perspective, and the government's trying to change that. But bottom line is that we have a lot of gold, right? So that's the starting point. And from there, if you come one level down to gold finance, so if you have large amounts of gold, a certain section, and that section is very, very small, an estimated less than 5% of the total gold is actually used for, financing. So it's a very small percentage. And even this 5%, about 35% is organized So 35% of the gold lending is done by organized players, and 65 is done by unorganized players, right? So there's a huge room for growth, not just from going from the gold that's being used to finance to take out loans, but also from the perspective of organized and unorganized players in the market, right? So that's the macro level view. Now moving to the micro, right? The micro is very obvious. I am an individual, right? I have gold, right? And if for whatever reason I happen to need a loan, want money, I can go to a gold finance company and actually ask. Now, the question is that I, as an individual, under what circumstances will I pledge my family gold to get a loan? And even as you hear this, I bet in your mind the first thing that's coming is that only when you're desperate you would do something like that. And while it's true that the conventional belief that gold loans are distressed loans, and that's kind of true, but a significant percentage of these loans are actually short-term business loans. So there are MSMEs, these micro, very, very, not even micro, very, very small entrepreneurs in semi-urban and rural India, and they don't really get loans from the banks. So what they do is they pledge their gold and take business loans to fund their working capital, and these loans can go anywhere from 3 to 4 months, which is the mostly loans fall in that duration, all the way up to 2 years. So these are very short-term loans, right? So working capital loans, business loans is one significant percentage. Another significant percentage is used for, let's say, housing, refurbishing your house, marriage, education loan, all of these different types. And I really liked how, this analyst called Digant Haria, and he's very well respected in at least for the banking and the NBFC sector. He's ex JP Morgan, ex Angel Broking, and I recommend you check out his videos. But he describes business loans as a poor man's credit card. And I thought that was pretty ingenious way of describing it. Now, it is true that the conventional belief that gold loans are distress loans, obviously that's not a good thing for the industry. From the company's perspective, I want to change customers' minds so that they can come to me for gold loans, even if they want to meet their general household purposes, right? Or business loans or any other type of purpose. And in order to bring about that shift in the attitude of consumers, right? That's one. And secondly, when the shift in attitude does come, they come only to me as Muthoot Finance. That's where marketing comes in. I think marketing is something that Muthoot has done exceptionally well. Every 6 months, they try to come out with a high impact campaign, and they're present across all the different mediums, whether it is TV, radio, print, digital, whether it is by partnering with brand ambassadors such as Amitabh Bachchan or Madhuri Dixit, or by rebranding metro stations, as you can see in these pictures, or by doing these very ingenious marketing campaigns, right? And this one is exceptionally brilliant. It also won a lot of awards. So what they did was, at the Kumbh Mela, they found out that a lot of people who were going to do the snan karte waqt, they felt ki they couldn't leave their clothes. So people were always insecure about leaving the clothes. So what they did was they branded this, they created this huge locker branded as a gold locker, in Muthoot branding. And they asked people to leave their belongings with them, and they stored these belongings for free. And this was a great campaign. They did this in 2019, I believe, and this won a lot of awards. So they've done exceptionally well. Now, as an individual, I have gold. I've been exposed to such marketing, or I've been told by word of mouth. Now I want to actually take the first step, right? What is that first step? The first step now to actually taking the loan is to visit the branch. These days, there's also an option of getting a gold loan from home, but most of the customers would be required to walk into a branch, and they can walk into any one of the 4,672 branches that Muthoot Finance has specifically for gold financing across India. Now, granted that 60% of these branches are in the south of India, and the reason for that is simple, because Muthoot Finance started in Kerala, and they're obviously dominant in that region of the country, but they also have significant presence in the north of India, west of India, but the least amount of presence in the east. Now, just to give you a context, Muthoot Finance's customers are basically the section of the society that are not easily able to get loans from conventional sources such as banks or NBFCs. So these are credit starved, credit hungry customers, and 65% of the gold, because it's with the rural population, these form a large part of Muthoot Finance's customers, right? Now, having said that, once a customer, me as an individual, I am there at the bank, at the branch, there are two very important questions that are going through my mind. One, if I leave or if I pledge my gold, give my gold, something that I'm very deeply attached to, sentimental value and obviously monetary value. If I leave this gold with Muthoot Finance, A, how safe is that gold? Will I get it back? And B, in the event that something happens, if there's a robbery, it's stolen or whatever, will I get my money back? And these are not very irrational questions to ask at all. These are very normal questions, because even a simple Google search will reveal that robberies at gold finance branches are not very common, right? So in front of you, you can see I've done a simple Google search, Muthoot Finance branch looted. There are so many instances. Gunmen loot 55 kilos, 16 crore. Uh, 5 men disguised as CBI officials. So very movie type incidents also happening here, right? So a customer needs to be made to feel comfortable about pledging their gold. The good thing is, the answer to the second question is that if you do pledge your gold, you take a loan, and for whatever reason, if that gold is looted or whatever, you actually get the monetary value back. Now, obviously, that's not the best case scenario, because that jewelry might have sentimental value, but at least in that sense, your money is protected, right? And this is this is an issue that is not only specific to Muthoot Finance, but all gold finance companies, right? And you remember in the beginning of the video, we talked about does the company have a competitive advantage? And I think this is where the comparative advantage of Muthoot Finance starts to emerge, right? Because a lot of players who enter in the beginning, and by the way, even at the starting of this decade, there was a huge boom in gold finance. A lot of new players entered, and they soon found out there were a lot of operational challenges. And the operational challenges come primarily from the fact that you have to store gold. And if you want to make this business profitable, you have to do it at scale. And to do it at scale, you need to have, you have literally, I think hundreds or even maybe thousands of tons of gold that you have to keep safe. And that's where maybe the comparative advantage begins to come out for Muthoot Finance. Now, I don't know exactly what that comparative advantage is, but I'm told that in terms of security, there are 13 layers of security that Muthoot Finance have. But a very ingenious example came in front of me when I was doing my research. And good thing that I don't know more about the security, because if doing research online, or if by talking to people, you can easily get to know how the security is set up. Maybe it's not that secure at all, right? But if for whatever reason you happen to be either working with Muthoot Finance or are an industry insider, and if you know more about how Muthoot Finance secures its gold, please drop me a comment or get in touch with me. I'd like to learn more from you, right? Now, but this was an ingenious example of how they try to protect this gold. And I read an article where there was a robbery, and there was GPS in jewelry helps Hyderabad cop snap 25 kilos of Muthoot gold, right? So I think this was very, very interesting and quite ingenious. The next big question on my mind as a customer is, what is the interest rate I have to pay to get a gold loan from Muthoot Finance? And the interesting part is, just like any other NBFC or a bank or any finance company, Muthoot Finance also offers differential rates of interest, right? So depending on the quality of the customer, the rates can go as low as 9%, 12%, 13%, and all the way up to 25, even 24%. But on a blended basis, on the overall portfolio or the total loans that Muthoot Finance has given, the blended yields, right, the interest rate that they charge is around 19 to 20%, give or take 1 or 2% on either side, right, across the last 10 years. Now, you might think that this is on the higher side, but let's bear in mind that these are customers who are credit starved, who normally do not get loans from either banks or other NBFCs. And their only other option is to go to a money lender, where a lot of things could go wrong. First of all, the interest rates they charge are over 25, even 50%, right? That's one. Secondly, the valuation of the gold itself, right, could be a little bit fraudulent. Thirdly, there is the whole big thing about trust, whether you'll get your gold back or not. And fourthly, these money lenders are not really regulated by RBI, so there is an added risk in that front as well, right? So keeping those factors in mind, paying a 19-20% interest rates on gold loans might not be a very bad idea for the customers, at least, that Muthoot Finance is targeting. The next thing that we want to keep in mind is, again, if you look at it on the overall perspective, right, for the 53 lakh active customers that Muthoot has, you'll notice how the total number of the assets under management it has is around 56,800 crores, and that's increased significantly from 2013 when it was 21,600 crores, right? Another interesting aspect you'll notice in the earlier graph on the blended deals that I showed you, and also on this, is that you'll notice that since 2020 there's almost been a flatlining. So as far as the interest rates are concerned, they're declining, right? As far as the AUM, total loans outstanding, right, which is the total size of the loan portfolio for the company, that is also flatline. And this is where we begin to see the impact, the corrosive, the negative impact of competition come in. And we'll discuss a little bit more as we go on, but this is where we begin to see how competition is impacting the company. Now, on the flip side, if I, as a company, again, Muthoot's perspective, if I'm going to give loans worth 56,800 crores, I also have to borrow that money. And on my side, as a company, I'm going to be borrowing it from banks, in the form of bonds and, different sources of funds. And as you can see on this chart, the different sources are borrowing from banks, secured NCDs, subordinated debt, commercial paper. So these are different forms of borrowings that the company has taken. But it's very obvious that most of the borrowing comes from the banks themselves. Now, next question that arises is, what is the cost that I am borrowing money at as the company? And we can again see that from 2013, the interest expense has reduced from 11.38% all the way to 7.02% today. But it's really not about how much interest I'm charging to the customer or how much I'm paying. It's really a combination of the two, right? The difference between what I charge to the customer and what I pay for, borrowing the money myself. And the difference between those two is called the interest spread. And loosely you can call it net interest margin as well. And this is really the number that we want to watch out for. This is super important, so we'll discuss a little bit more about that in the growth section as well as we go forward. But again, you notice the same trend. Despite from 2020, when gold loan market was booming like crazy, during the time when banks, doubled their total gold loan portfolio, during that time you see again a contraction in the NIMs. And again, because competition was high, because banks were able to attract customers at lower interest rates, you would notice that overall for all the companies that the competition is negatively impacting the net interest margins, the interest they can charge, even the growth in the total loan portfolio. The next big step from a customer's perspective is to actually start repaying the loan. And this is where the real game begins, because for a finance company, giving out loans is really not that big of a deal. It's actually getting all the money back. And for Muthoot, the dynamics here are very interesting, right? So as far as repayment is concerned, from a customer's perspective, I can either walk into the branch and repay, which is the conventional standard way, or I can also now repay through the online portal, right, which is called Muthoot Online. And this is nothing exceptional. I think every finance company is allowing customers to pay online, so nothing exceptional here. But the exceptional part is if a customer is unable to pay the loan, right? So the standard definition of NPA is that if I'm unable to pay my loan back over 90 days. So for 90 days, if I have not cleared all the dues to the finance company, the account will turn NPA, non-performing assets. But here's the interesting part about NPA from Muthoot's perspective, right? The reason why it's so different is because Muthoot actually takes, gold loans, right? And the interesting part is there is something called LTV, loan to value. And RBI restricts the loan to value to 75%, which means that for every 100 rupees worth of gold the customer leaves or pledges with Muthoot Finance will only maximum give a loan of 75 rupees, right? So inherently to begin with, it has a margin of safety of 25%. But if you look at the chart on your screen now, you'll notice that Muthoot Finance actually has a margin of safety which is way higher than 25%, signaling a more conservative approach, right? So that's one. Secondly, in the case where NPAs do increase, as you can see from this graph, at different points in time, NPAs will increase and decrease. The interesting part is even though the NPA ratio has increased, the company doesn't really lose any money almost ever, right? To give you make this more concrete, what I mean is look at that. So the percentage of bad debt written off to total loans is basically 0.01, right? So it's practically 0.04, in the worst case 0.05%. So it's practically never losing money, simply because it has a margin of safety of, in some cases, 35%, right? And B, even in the worst case scenario, when it has to sell off the gold, it can simply liquidate it into the market and get its money back. So from that perspective, it might seem like gold finance is an easy to understand business. It might be easy to execute. We've already discussed why it not might not be so easy. And three, it you almost never lose money. You combine all those three and you can see why a lot of people would think that this is a business that they can enter and steal market share and all that, right? But with time, and we'll discuss this in a little bit more, we've realized that this is a tough business, and although competition can impact the business over the short term, as it has over the last 2 3 years, in the long run, a lot of these players who are cutting the interest rate, right, to gain customers, will realize that they will not be able to operate at those margins. And with that, the customer journey comes to an end. If they've paid their entire dues on time, the gold is returned to them. Now they might choose to come back to Muthoot Finance and get another loan, increase the total loan that they've taken, etc., etc., depending on how great the service was, depending on do they have any other great alternatives or not, etc., etc., right? But now the real question is, how great of a company is Muthoot Finance, right? How do you judge that? How do you answer that question? And if we were to condense this entire journey that we've taken, which is the business of Muthoot Finance, right? And if we condense this into this flow chart that you can see on the chart, really the efficiency with which the entire process, this entire cycle is kind of turning, that maybe can give us help us answer the question of the quality of this business, right? And this entire efficiency of this cycle, right, of the business is reflected in the financial statements. Specifically, let's begin with income statement, because fundamentally an income statement is exactly that. It basically captures the financial position of the company in terms of numbers, right? But if we were to make it even more simple, if there was one metric that we can use to judge the quality of the company, that metric would be return on equity, right? Return on equity basically means for every 100 rupees of owner's equity, right? Owner's the equity in the company, how much profit can a company generate? And in the case of Muthoot Finance, as you can see on this chart, it has varied a lot across the last 10 years, hitting a low of 14-15% in 2014, 2015, all the way up to 27%, right? So it has seen a lot of ups, highs, and lows. But even today, as on not today, but March 2022, the number was 23%. So a lot of retail investors would look at this number and say, even if it's 22% today, it's still great, even though it's reduced from 27%, 22% bhi bura nahi hai, so why should we not invest in the company? Well, the fact of the matter is, the way you want to interpret ROE is that ROE basically tells us the ability of the company to generate value, right? And in this case, every 100 rupees, it can generate 22 rupees, right? But the fact is that it's not necessarily the absolute number, because a business is not really a snapshot. It's not a picture fixed in time. It is a movie which is moving across time, and therefore the absolute number is important, but it's also more important to take into consideration the directionality of that number, in which direction it is heading. And because stock markets are fundamentally a discounting machine, meaning stock markets try to look into the future, and as a market as a whole, it reaches a consensus about what will happen to the ROE, the efficiency of the business, the quality of the business in the near future, however far it is able to see, and then it discounts, or it basically takes that into the consideration today. And so when the ROE decreases, even though it's going from 27 to 23, 23 is an excellent number, it still means that the business is becoming worse than it was 1 year ago, right? And obviously that means the ability of the business to generate value has declined or become worse compared to a year ago, right? And that's a very, very important key part to remember, to keep in mind. Another thing is that in order to understand whether over the near future ROE will increase or decrease, we have a tool called ROA tree, and we've talked about it extensively. It looks something like this. We've made a video. We strongly recommend you check out the video, right? But zooming into ROE specifically, because it's so important, we can see that yes, compared to the 9 months of FY22, the first 9 months, compared to this year, the ROE has further decreased from 24% to 17.8%. But you can see that quarter on quarter, Q1, Q2, Q3, or the last 3 quarters in this financial year, right, things are slightly beginning to increase. And again, this is a reflection of competition as well, right? Because competition was very heavy over the last 2 years, ROE had reduced, and the company had to offer really low interest rates, teaser rates, which means that the net interest margin had decreased. We already saw that graph. Because of that, the ability of the company to generate value, ROE, has decreased, right? But slowly, as competition is cooling off, the ROE is increasing. But the value of a company is not only dependent on its ROE, but also the growth, right? And by growth, we mean the overall assets under management growth, and AUM growth is a function of the total value of gold that is pledged with the company. And the total value of gold pledged with the company is a function of 3 different factors. One is gold prices. So if you have 1 ton, which the value of which is today, let's say 1 lakh rupees, if the price of gold goes up to 1,50,000, it means you have more value for the same physical amount of gold, which means you can give higher loans, which means it'll increase the assets under management. The second way to increase AUM is if the company decides to increase the LTV. As we already discussed, the LTV limit is 75%. Now, Muthoot, being a more conservative player, usually likes to keep this LTV at around 60-65%. So if it wants to grow, it can also increase this LTV. There is a margin for growth in that in that aspect as well. And the third thing that can increase, obviously, is the overall gold stock that is available with the company, right? And that is a function of the number of customers that a company can acquire. So it's a combination of all of these factors, and that in turn determines the AUM growth. And different periods, there are different factors that contribute to growth. But over the last 8 quarters, because of competition, because of banks becoming super aggressive in the gold finance sector, as we've discussed, the growth has been coming down, and it has sharply reduced from 30.9%, and this is Q on Q, year-on-year growth for a quarter. So third quarter FY21, it was 30%, and it reduced to 3.8% by September, or the second quarter of FY23. So growth has been sharply coming down. But last quarter, we're again seeing some signs, just like we saw some signs with ROE kind of increasing a little bit, we're also seeing growth coming back. So valuation is a function of both ROE, which tells us about the quality of the company, and growth itself. And it's almost like a balancing act between the two. But if I had to choose one over the other, I would rather have a company that is maybe lower than its average ROE. So if the average ROE is 20% and the company is at 18%, even that is better as long as the growth is higher, or whatever a reasonable amount of growth is concerned, versus if you have a company which is a very high ROE, maybe even 25%, 30%, but it's not growing at all, right? The market would almost inevitably, in almost all the cases, award growth much more than a high quality company alone, right? With that said, let's try to value a company, and here I've built a very overly simplified model for trying to understand the valuation of Muthoot Finance. Let's not get too precise about it. The idea is to understand, just to get some basic idea, right? So what I've started with the book value per share. This is for the standalone company, not for the consolidated, which is 479 rupees per share, right? That's the book value as of today. And I've assumed three different scenarios. The bear case, where we're expecting 7% growth over the next 2 years, right? And we'll discuss why 2 years. We have the base case, where we're expecting 10% CAGR over the next 2 years, and bull case, where 15% growth is what we're expecting, right? Now, if you were to calculate book value per share at the end of FY25, we would end up with 548, 580, 633, depending on whether it's the bear case, base case, or the bull case, right? And accordingly, we've assigned some price to book value for each of those scenarios. If the company is able to grow only 7%, it's almost inevitable that the market is going to punish the company, right? And in that sense, the price to book value, which is around 2, will likely reduce to 1.5. So you multiply 548 into 1.5 and you get the price of the company, right? Which is 822. So at the end of FY25, in the bear case, you'll end up with a price of 822, which means a market cap of 33,000 crores, which is basically less than the market cap today. So this is the worst case scenario, obviously, and that's why it's called the bear case. The base case is 10%. The reason why we've assumed 10% is because 10% is the growth the management is guiding for FY24. This year the growth is going to be around 5-7%. Next year, the management is saying the 10% should be the growth that we're looking at, and this 10% is the AUM growth. So it's likely that maybe profit growth might be higher, but we're assuming 10%. If that's the case, book value per share will be 580. And because it's the base case, nothing really has changed much from today's condition. At the end of 2 years, we're assuming price to book value will be 2, which leads to a price per share of 1200 rupees. 1200 rupees, which means a market cap of 46,000 crores, which means a stock CAGR of only 8%. Again, not the best case scenario. The bull case is where we assume that 15% growth happens. We end up with a book value per share of 632 rupees, and because it's a bull case, which means that the growth is going to be higher than we are expecting if this happens. Again, it's an if. If this happens, market is likely to slightly reward the company, and this might go to 2.5, which means we have a price of 1583, market cap of 63,000, from around 32,000, 33,000, something like that. So which means we have a CAGR of 19%. So only and only if the growth in book value per share turns out to be 15% or thereabouts, in that range, in that vicinity, we're going to likely expect a reasonable return on the stock, right? Again, the big question is if 15% is going to happen. And another interesting aspect is the reason why I've only taken 2% is because of a very fundamental fact about the gold finance business, right? And I want to show you this chart right here, right? So it's a combination of 3 charts. We have the gold prices over the last, 20 years. We have the ROE last 10 years and the stock price. And what you'll notice is between 2005, there's a very, not between 2005, but there's a very strong correlation if you look at these graphs between the prices of gold and the performance of the company, right? And the fact of the matter is that gold prices, at least for myself as an investor, are kind of unpredictable. I really don't know where gold prices are going to go, right? And therefore, to that extent, you can't do a valuation projecting over the next 3, 5, 10 years, simply because you don't know where gold prices are going to go. And gold prices in and of themselves are speculative in nature, in that you don't know where they're headed, right? But there's a strong correlation between increasing gold prices and the performance of the company, so much so that between 2007 2005, the price of gold nearly tripled, right, leading up to 2011. And not surprisingly, 2011, right at the peak, when you had a long 5 7 year period of track record showing the company is great, things are going well, that's when the company actually listed. The IPO came in 2011. And if you notice, from 2011 to 2015, the the gold prices virtually tanked. And again, you see the same trend in the ROE as well. Competition increased, prices of gold decreased, and you have the company's ROE declining to a low of 14.3%, right? Then from 2015 onwards up until 2020, again you see prices almost doubling, if I'm not wrong, and you see the same trend. ROE increases, the efficiency of the branches increases, uh, you know, operating leverage kicks in, growth kicks in. All of those things have wonderful things happen, and you reach a high of 28% ROE. And similarly, you see 2015 onward. Uh, 2015 onwards, you see stock price has really taken off, right? So the whole idea is that the gold prices are fundamentally what is driving the business. Now, maybe this same pattern may not repeat in the future, because maybe there is an attitude shift in the mind of the gold finance consumer. Maybe they're more open to taking gold finance loans, and even though gold prices are not going up, people are more and more people, out of the 1.5 trillion of gold that we hold in India, more and more people are just comfortable taking gold loans. Maybe the growth can come from there. Now, I don't know about that, but it's very clear that the stock price and the performance of the company is very closely linked to gold prices, right? So hopefully this video has been insightful. Hopefully this has given you some insights. If there's anything you felt that you wanted to add to the video, or something that you want to share, if you have any questions, please feel free to leave them in the comment section. And if you like this video, if you're still watching, please consider subscribing. Yeah, that's pretty much it from my side. I'll see you in the next video.